Welcome to the TrustedBridge Capital monthly video series entitled Know What You Own. I'm your host, Eric Jefferson, and for this month, we're going to take into what has been, up until last month, a fairly forgotten asset class. I'm going to dive into U.S. small cap equities, talk a little bit about what they are, how they've performed, as well as some of those recent drivers of performance. Now, before we get started, you can see we have a few quick words from our legal team. With that, we can go ahead, dive right in, and we'd like to start by first defining small caps. As their name suggests, these tend to be much smaller in size as a organization. The number of employees they have, the number of clients they work with, the revenue that they generate. These often tend to be newer companies, but granted, have grown large enough to be listed on publicly traded stock exchanges. Being that they are smaller and newer, they tend to offer more growth prospects. That being said, their growth is often tied to the overall growth of the economy. That is what we define as being more cyclical in nature. Also, when we think about their capital structure, they may not have a large surplus of cash flow. Therefore, they tend to have a greater reliance on debt. That in turn is issuing bonds. That, relative to the large cap companies, makes them much more sensitive to changes in interest rates. If interest rates go up, their cost to continue to fund their operations increases as well. And then lastly, from a market standpoint, they can be very volatile. They do require a great deal of patience, but that's something we'll explore in the next page, the benefit of having that investor discipline. So we think about some of the recent trends. As I mentioned in the opening comments, small caps had all but been forgotten as we go back to the beginning of 22. You can see there S&P 500 over that period up about 19%. We've talked at great length about the concentration in the S&P and how a select handful of mega cap tech stocks have really led the way. You can see those outlined there below. These are companies that have really benefited from that AI theme. You can see they have done more than 2.5 times the return of the S&P over that period. Meanwhile, small cap stocks, as classified by the Russell 2000 index, negative over 6%. Now, we think about going back to the beginning of 22, a lot of concerns about a slowdown in economic growth. We've seen interest rates skyrocket. So not surprisingly, you've seen small caps meaningfully underperform. However, fast forward to the month of July 2024, that has been a very different story. You saw the Magnificent Seven now give up some of that ground, down about 3%. Meanwhile, the small cap index, you can see delivering investors double-digit returns. Now, why is that? Well, we continue to get a lot of data from a growth standpoint. The economy is continuing to expand. Small caps much more tied to that overall growth. That's certainly a benefit as well. Where we have seen some softening in the labor market, that suggests, coupled with continued progress on falling inflation, that we will have some interest rate cuts coming in the very near term. That obviously bodes well. But the last piece I want to highlight is that far right-hand column. The price to earnings ratio is a measure that we use in the investment management industry to try and quantify how expensive or inexpensive a company's stock or price is relative to the underlying earnings that it generates. As you can see here, S&P 500 currently trades at 26 times its current earnings. That figure is very much towards the higher range of his historical basis. You can see the Mag 7 nearly 1.5 times that, 40 times price to earnings. Now, for growth companies, again, you go back to 2000, we think about the first internet stocks. Obviously, there was a boom and bust period there. Not suggesting that will follow suit this go round, but not surprising to see valuations for these potentially explosive growth names trade well above averages. But the key piece I want to highlight here in that bottom right-hand corner, small cap index trades at less than 15 times. So the thought process being, If we do continue in a soft landing type scenario, if growth does continue to progress, let's say that small caps do grow at a similar rate to their larger counterparts designated by the S&P 500. In essence, you are paying half the price for the same amount of earnings if you own smaller caps versus large. That thought process, I think, as of late, has made small caps particularly attractive. Again, not only from the prospect of if the economy continues to grow, you likely have more upside with these names, but conversely, although small caps can be very volatile, if we do have a slowdown where these companies are already so cheap, there's likely more of a floor with respect to price for some of these names as opposed to those that have had some incredibly strong performance as of late. So we hope that's helpful. As always, happy to answer any other questions. If you don't connect, have a great rest of the day, and thanks for tuning in. Take care.